SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to today's SUERF Buffy Bocconi online workshop on the topic of SSM, EBA bank stress tests, key findings, and the way forward. When the SSM EBA stress test was published in late July, all experts and observers in the field were wondering what impact the COVID crisis has had and might still have on banks' resilience. The question is all the more relevant as the COVID shock may not have fully unfolded yet when it comes to firm failures and the resulting loan losses. Beyond this, new expected shocks will no doubt come and also challenge banks. Rising interest rates, the next downturn or even crisis, and climate change sure are obvious candidates. To shed light on these complex issues, we have an outstanding group of senior experts with us today. We have the great privilege to have Gottfried Haber, Vice Governor of the central bank where I come from, the Oesterreichische Nationalbank. Gottfried will introduce the topic and put it into a broader context, and Gottfried will also be the moderator of today's event. Then Jakob Gyntelberg, Director of Economic and Bank Analysis Department of the EBA, and Carmelo Salleo, Head of Stress Testing Modeling Division at the ECB, will present key findings from the latest stress test and draw implications going forward. After this, four eminent experts will discuss these findings and offer some, I am sure, also critical perspectives. We're very privileged to have Giorgio Bonomo, Senior Expert Risk Management Practice of McKinsey and Company, Jakob Haan, SUERF's President and Professor at the University of Groningen and former Head of Research at the Dutch National Central Bank, Fernando de la Mora, Managing Director at Alvarez and Marsal, and last but not least, Elena Iparraguirre, a European bank analyst at Standard & Poor's Global. Without further ado, I hand over to Gottfried Haber.
Thank you very much, Ernest. Very warm welcome also from my side. Before we go ahead, let me take a look at the beginnings of the EU-wide stress tests, which have evolved in quite a substantial manner over the years. The first EU-wide stress test was run in 2009, more than 10 years ago, and in those days by CEBS, the Committee of European Banking Supervisors, the predecessor of the EBA. 2011, EBA has replaced the CEBS, and with a stronger mandate, they have continuously refined and further developed on the methodology of the stress test. Then, 2014, the ECB was mandated with supervising the euro area's largest banks. You remember the anniversary we had 1.5 years ago. And there has been an important change in two aspects. First of all, the ECB replaced a large number of national authorities as a single party, ultimately responsible for the quality assurance of the results. And second, it extended the exercise from the largest banks on the one hand previously to other smaller banks in direct supervision as well. So what we have today is in fact two interlinked exercises. It's the EBA stress test for the largest banks in the euro area and in the other member states. And on the other hand, the SSM stress test for the remaining SIs under the responsibility of the ECB. So not only the stakeholders have changed, also the focus of the exercise has shifted. First of all, in the beginning, it was kind of a pass or fail exercise with the focus on capital shortfalls, especially during the European sovereign debt crisis, where a dedicated capital exercise was launched. But after that, it transformed into a supervisory exercise without a defined hurdle rate. And that also was important to support supervisors in their risk assessment. Today, findings from the stress test feed into capital buffers, mainly by the Pillar 2 guidance, a capital buffer, which is not legally binding, but supervisors, we as the supervisors expect banks to hold on top of the capital, of the binding capital requirements to be better protected against adverse developments. At the same time, and also from the very beginning, the EU-wide stress test was also about transparency, providing market participants with the means to perform their own risk assessment. And in this sense, EBA publishes thousands of data points per bank. There is some wealth of data and transparency practices of supervisors in other countries, which look quite, let's say, pale in comparison to what we have here. This year, for the first time, the ECB has also published individual bank results. That's the second of the interlinked exercises I spoke about, although in much lower granularity due to privacy and security issues and non-disclosure issues as well. But to be honest, there is not only sunshine, and where the sun shines, there is also kind of shadow. So there has been criticism against the EU-wide stress tests as well. Especially in the beginning, there was harsh criticism concerning the credibility of the exercise. The scenarios were deemed not to be conservative enough. We had some methodology discussions. It was very flexible at first, but then banks used this leeway to get some advantage, because if you have practical consequences on capital requirements, you might be tempted to report overly optimistic numbers. Supervisors responded by a more rigid methodology and tougher quality assurance, which made the process, on the other hand, a little bit more cumbersome, and that led to complaints from the banks as well. So overall, there has been quite development, lot of advances since 2009. And the stress test results are always, and also this time, eagerly awaited by the market participants, because they also have implications for dividend distributions. The main question remains, and there is no easy answer: should we focus on comparability, same results and same framework for everybody? Should we allow more tailored approaches for specific cases? Let's say, consider special business models, special situations of banks. Results might be comparable, but will they also be realistic if they are standardized? Should we allow credit growth and management actions during the stress horizon? How much freedom should we give to the banks to use their own methodology, which might be more tailor-made on the one hand, but on the other hand, lead to lack of comparability? How do we ensure level playing fields? How do we calibrate the system, the level of conservatism in the process? And last but not least, we have ongoing discussions, and that's not new. Should the supervisors run the calculations instead of the banks? Should there be supervisory views and bank views? So a lot of questions which should and can be discussed here, and I'm looking forward to that. Last year, the EBA has therefore launched a public consultation on future changes to the stress testing framework, and currently there is a discussion on the feedback that had been received. Progress has also been made in other fields of stress testing. Macroprudential stress tests now incorporate more dynamic elements, amplification mechanisms, to partly at least capture feedback effects. Well, a typical bank-by-bank stress test would not be able to do this. The big topic, of course, also in the field of stress testing nowadays, is climate risk and the potential impact on the financial sector, and the question how to incorporate climate risk. Should we have a separate climate stress test? Should climate risk be incorporated in a very similar way to every other type of risk. So a lot of questions. Let's start with the first speaker, Jakob. The floor is yours.
Thank you very much, Gottfried. And honestly, thank you for inviting. It's good to have an opportunity to share the results and have a bit of debate, because obviously this is one of the reasons these exercises are undertaken, right? Before us, we have a recently completed stress test, and I think it's fair to say we have, this is a stress test that involves roughly 50 banks from the EU area, covers 70% of the assets. So it's been postponed for a year due to the pandemic. So we're a little bit behind, if you will, but still, I think the first point to make is that, and I'll get back to this, this year's scenario is quite severe, more severe than the one we used the last time. And it has a very specific focus basically on the impact of the pandemic. It's sort of a lower for longer idea. If I take sort of the highlight outcome from a capital perspective, we have a depletion of roughly 500 basis points on average in the CET1 ratio. But even so, I think because banks are better capitalized than in the past, we end up with being above a 10% CET1 ratio on average. So that is, in a sense, a comforting outcome from a regulatory sort of stress perspective. And I think it shows that the regulations have in fact worked. Again, I would say, as in previous years, credit risk remains the main driver of the capital depletion. But we also, and this is partly due to the scenario, we do see a higher impact on net interest income compared to previous rounds of stress tests. We also find that banks that are more focused on domestic activities take a bigger hit, and those that have lower net interest income also have a higher depletion in capital terms. So if we move on, let's maybe go into the, if we go into the, okay, so I think we have, right, so if we move on, it's fine. Let's take the scenario first, because I know Carmelo is waiting for me to say a little bit on the scenario, because he will rely on me for that. So let me do that first. So we have, as I said, a narrative focused on a pandemic that doesn't go away. I hope it's wrong, obviously, but this is supposed to be a stress test. So we are looking at quite a steep decline in GDP from end 2020 levels. So we end up being 3.6% below after 3 years, which is quite a lot. And it's 12.9% below baseline, right? So 3.6% below end 2020, which was already not a great year due to the pandemic, but it's even lower than the baseline scenario, yeah? At the same time, we have quite a severe increase in unemployment rates. So basically it goes up from roughly 5 to a little over 12% over the 3-year horizon. And I think we also assume in the scenario that other major regions are affected quite severely in terms of macro outcomes. But this just gives you a sense, right? If we move on to the next slide, we are also seeing a decline in consumer prices. We have decline in residential property prices. And we have a decline in long-term rates, which is part of the explanation for the NII outcome you'll see in two seconds. If we take the next slide. So first, let's have a look at how it evolves over the 3-year period here. So if I take either the transitional or the fully loaded, they're not that different actually. You can see we go from having roughly a little over 15% CET1 ratio down to around 10. So the difference here, and I think what's worth noticing is the gap. The gap is a 500 basis point gap in both cases. So not that big a difference between sort of a transitional and a fully loaded starting point, right? But I think it's also worth noticing, I will include in the slides that'll be circulated, there'll be individual bank data, right? But the range across banks is quite substantial. Some only have barely a 1 1% decline in CET1 ratio. Others quite a bit more, almost like a 10% decline. So there's quite a bit of dispersion, but on average, this is what it looks like. So as you can see, again, from a sort of a big picture perspective, it shows a banking sector that's reasonably robust, even if we take them at the end of 2020 and put them through the ringer here. So I think it is in that sense comforting, right? If we move on, here is a bit on the leverage ratio, just to give that as well. As you can see, a gap of about, at the end of the horizon, roughly 1.5% between the gap between the baseline, where the leverage ratio actually goes up a little bit, and the adverse scenario. You can also see the distribution of the leverage ratio shows that most stay at reasonable levels. There's a few that end up being below the 3% mark at the end of the stress test horizon. If we move on. Here we try to cluster the banks. I think this is one of the things I mentioned at the beginning, but here's what you can see, the clustering. So if I take the, if you will, sort of a business model type approach, where I look at the banks that have more of a domestic concentration versus the more diversified ones, it pays to be diversified in terms of having a little bit less depletion. If I look at the earnings levels, the net interest income, that is, of course, the first barrier of defense in terms of absorbing losses. So perhaps not so surprising that the high NII banks fare better than the low NII or the non-high NII banks, right? Finally, we just check for bank size. That doesn't seem to have a material role to play in terms of capital depletion. If we move on. So I think here, maybe just to be clear, there's also, again, a few facts to highlight. It illustrates, again, the severity of the scenario. Clearly, an increase in the stock of provisions, which has been bigger than in the previous exercises. That shows also in the stage 3 share. So there's a bigger increase in the stage 3 exposures. And I would say we should be noted that actually the starting points in terms of credit risk for the banks at the end of 2020 was better than the one we had in 2018. So we had a little bit less stage 3 loans this time around. But at the end, I think with a combination of what is a more severe scenario, but a better starting point for banks in terms of capital and the credit risk composition, we end up roughly with the same credit risk impact on the CET1 ratio. So the 425 basis points. So that was sort of, those are the main findings, right? We can get back to it if you have more specific questions, but in the interest of time, I thought I'd just move on. Let me talk briefly about our pilot exercise on climate risk. So if we move on. So first, I would say we are very, very grateful to the collaboration with the banks that participated. That was a very positive experience from our perspective. And I would say the exercise here was basically not so much, I think, to really get capital implications teased out. I think it was more to see what can be done by learning by doing exercise. So I think first exercise here is to actually have an ability to map the bank's portfolios to credit risk, to climate risk aspects, which is not so easy. I think that was a bit of a challenge, right? So I think this is basically sort of getting a sense of the methodology and data challenges that we face. That was, I think, one of the main objectives here. Also, I would say, of course, we have an EU taxonomy, so part of the exercise was also to see how does that work in practice. Are banks able to use it? Does it sort of make sense? Is there anything we need to think about when deploying it? So if we move on to the next slide. So what was done? Well, first there was sort of a core analysis and a mapping from the portfolios to various measures of various ways to classify exposures. There was a focus on non-SME corporate exposures, both IRB and standard approach, so non-financials. And then a data collection that ran through most of 2020 to get this done. Yeah. So this is voluntary exercise. Actually, 29 banks, 10 jurisdictions. Actually, 50% of the banking system assets. So quite a good coverage, I would say, for a quote unquote exercise. And we had banks across the 29 banks, quite a bit of heterogeneity also in business models, which I think is a good thing if you want to understand how well we can do this and what the challenges are. So if we move on, I think if we look at what happened, right? I think we had two scenarios from the NGFS, and I think I'll focus here on sort of the bad ones, right? This is after all sort of a semi-stress test exercise. So this is a disorderly adjustment to climate change, and then there's a hot house where you don't do very much. And as you can see, it is not trivial in terms of if I look at the losses in terms of RWA, right? So it's sort of somewhere around 1.5 to 2% of risk-weighted assets. That's the loss magnitude under the two not so good adjustment scenarios. So again, I would say not small potato in terms of impact, but maybe also not as dreadful as some could have feared, right? So I think here, I would say clearly one of the lessons is that there's more work to be done. The classifications that was not easy for the banks. And that means that translating the composition of the portfolios into possible impact is an imperfect exercise here. I think that's just something we need to recognize. But still, I think very useful exercise. So if we look a little bit ahead, so what are we going to do? I think on the EU-wide stress test, I think we have at least on my to-do list, and I know that others here have a role in this as well and have given input. So I think what we have is I think we continue to strive to improve realism. I think we're also in mindful of what Gottfried said. I think we'd like to increase efficiency and maybe lower the burden a bit on all participants, banks, as well as regulatory agencies. So here there's a choice to be made. Finally, we are, and this is linked to bullet number 2, I think we are looking ahead. We're hoping to get a little bit of the benefits that you get both from a top-down and from a bottom-up exercise. So there are going to be some modifications. Having said that, I'd say at heart, this will remain a bottom-up exercise to a very large extent. I think there are areas where we are debating a bit more top-down approach. I think here, the candidates that are on the table are NII and NFI, as they are probably easier to do a credible top-down exercise on. And hopefully that will make it a little bit less cumbersome for the banks. So that's one area. That's sort of housekeeping and continuing to evolve the existing toolkits. The other big task ahead of us is you'll hear more from Carmelo here on this as well, is how do we handle climate risk in the stress test? So I think first of all, there's some of the learnings we need to take from the pilot exercise, as well as from what Carmelo will talk about in 2 seconds. We're going to have to think about how do we map exposures into climate risk dimensions. Here it's both physical and transitional risks. And then I think there's just a general theme on data and methodology, which is, I think, a well-recognized challenge both by the private and the public sector here. So we're going to continue to do that and see what is in fact doable in a credible way if we want to do these things, right? So I'm a little bit here, maybe a few extra comments from my side, namely that if this is a structural change, the implication is that we don't have good historical data on the marginal impact of climate change on various risk categories, credit risk included, right? So maybe we can analyze tax changes, higher CO2 taxes or whatnot in a better way, but the physical risks are a challenge. And I think in general, the understanding the marginal impact and distinguishing that from the broader risk drivers, that is an empirical challenge that we're all facing. So there's some work to be done here. And I would say we are going to have conversations with people about this, and we're of course already now discussing format and approach as to how EBA will do this for the next round. I think this is as I mentioned to the panelists before we went on air, this is a challenging field, and there's a lot of good work being done. So of course we will try to reflect and steal with pride and learn with pride from what others are doing in this area. I think those are the two main dimensions I'd like to flag in terms of what's next for EBA and the stress testing efforts that we undertake.
Thank you very much. So I would suggest that we just go ahead and would like to give the floor to Carmelo.
Hello, everyone. Thank you, Gottfried. Thanks to the organizers of this event. Let me start with the usual disclaimer. The presentation reflects my views and not the ECB's. This presentation, like Jakob's, has two parts. One relates to the EBA SSM stress test of 21-23, and the second part is a preview of our climate change stress test, because I think the two things, like Jakob just explained, link well together, and they speak to the broader theme of stress testing. So if we go to the next slide, so what we call macroprudential stress testing? Basically, it is a framework in which, compared to the EBA framework, we are less detailed at the level of the individual bank, but we try to model how banks would react to an adverse, or also to the baseline, but mostly to the adverse scenario, and whether the bank's reactions, how it affects individual banks' solvency positions, and whether this affects the economy. So basically, it's a complementary metrics to judge the resilience of the banking sector as a whole by acknowledging the endogenous reactions of banks. You can think of it something similar to the IMF FSAP exercise, which are dynamic, except that they do it every time for every country with an ad hoc framework, and we have an integrated framework for all the euro area, so all the countries and relevant banks. This exercise informs banks and mostly supervisors about the most likely decisions, and it can be used also to assess and calibrate policy measures. What do? We use the EBA scenarios, the baseline and the adverse. We have a dynamic balance sheet framework and two amplification mechanisms. One goes from bank solvency to bank funding costs. If the probability of default of a bank increases, this increases funding costs, which has a negative impact on profitability and therefore further worsening the solvency issue. And then within the banking sector and the real economy, basically, if banks react, for example, by deleveraging, this creates a credit crunch, which can make an adverse scenario even worse. And the question is, how much worse does it make it? And that depends in any given moment on the severity of the scenario and on the starting points of banks. This framework also allows us to model prudential policies, even bank-specific ones. We used it, for example, to provide a cost-benefits assessment of the Basel III finalization package to the EBA and the European Commission. So we can use it to model macroprudential and microprudential measures, profit distribution restrictions, public guarantees, and moratoria. If we go to the next slide, this basically describes the model and the feedback loops. We use a semi-structural design. We have a relatively detailed exposition of banks' balance sheets, so it's a lot less detailed, of course, than the EBA exercise, but it's a lot more detailed than a standard macro model with banks. Then we map the economic scenario into banks' balance sheets. We estimate banks' reaction functions from past data, and then we see how they react among a certain number of dimensions. So lending, on the liability side, deposits, profit distributions, interest rates, so the credit spread they put on top of reference rates, and possible write-offs of bad loans. If we go to the next slide, these are the two feedback loops. I won't get into the detail of them for the sake of brevity here, but basically, as you can see, there is a feedback loop within a bank, which then goes aggregated. If we aggregate all the bank's reactions into a feedback loop from the banking sector to the real economy, which is at the core, if you want, of the macroprudential mission. The great financial crisis showed us that the aggregate reaction of individual banks' decisions can have an impact on the economy, and that is the core, if you want, of the macroprudential perspective. So if we go to the next slide. So what happened with the 21-23 scenario? It's worth mentioning, as Jakob said, that this is a very severe scenario for specific reasons due to the fact that we are still in the middle of a pandemic, and so it is unlikely but still possible that things go very wrong in the next few years, which comes on after a very bad year, which was 2020. So this is like having stress on top of a stress situation. And what we see here is that if we look at the baseline scenario, which is the most likely scenario, the CET1 ratio of banks gradually returns to its pre-pandemic level, while in the adverse scenario, it goes down like in the EBA scenario. And in the adverse scenario, in this dynamic framework, we have about 43% of banking sector assets belongs to banks that have to dip into their capital buffers, and 14% of bank assets belong to banks which would reach their hard requirements, which would then mean the need for capital measures. If we go to the next slide, we see that profit distribution policies affect bank solvency, in particular in the adverse scenario, because banks make losses, they stop distributing dividends, at least in this model, and that is one of the two ways in which banks preserve their capital positions. Because if you want, the essence of the problem is that in a dynamic framework, banks make decisions that are individually rational, such as cutting dividends and reducing lending, but collectively have a negative externality on the economy because they generate a credit crunch. So this is what we're trying to get at here. If we go to the next slide, we see that profitability in the baseline scenario goes back to the relatively low levels pre-pandemic, while of course in the adverse scenario, credit and market risk losses decrease significantly. I mean, bring banks into negative territory and consume their capital. If we go to the next slide, what we see with this exercise, we also look at the COVID-19 mitigation policies, and we see that in the baseline scenario, there is robust lending growth, while banks deleverage in the adverse scenario. But assuming that in the adverse scenario, we would have, again, the mitigation policies that we had in 2020, so that they would be extended, then we see that these mitigation policies actually work quite well and have a significant impact on deleveraging, reducing it significantly. Indeed, if we go to the next slide, we see that without these measures, the deleveraging of banks would generate a negative feedback loop, which would put the economy 1.6% points of GDP lower than it would from the starting point of the adverse scenario. But the mitigation policies would erase 1 percentage point of that. So the bottom line is, if we were to have this adverse scenario and policymakers were to simply replicate the measures already taken without making them stronger, there would be a small feedback loop worth more or less a half point of GDP. And that is much better than having 1.5 points in a situation which is already pretty bad. So if we go to the next slide, what are the main takeaways of the macroprudential stress test? Well, in the baseline scenario, bank solvency and profitability look good. They go back to pre-pandemic levels, which shows that if things go according to plan, the banking system will have shown to be quite resilient to a worldwide pandemic. There would be lending growth in the baseline scenario. The results of this exercise, together with other exercises we performed on profit distributions, which were used by the chair of the supervisory board of the ECB to explain why there was a recommendation to refrain from distributing profits. These exercises show that these measures are key in preserving bank solvency during a pandemic. And so during the pandemic, if we were to have more, this would be an important tool, which can then be phased out quickly afterwards. In the adverse scenario, lending actually contracts, which generates a negative feedback loop. And last result is that the availability of public guarantees and other COVID-19 mitigation policies would have a significant positive impact on the banking sector and basically break the adverse loop that would be generated by the recession. So I think that now if we move to the next slide, we're moving into our climate change stress test. Now, what is this exercise? We performed an in-house exercise in order not to put additional burden on banks in a moment that was quite difficult. And as Jakob said, this is a new field, and we acknowledge that we basically only started to scratch the surface. However, let's say that we learned a lot, especially we learned a lot about all the things that we don't know, that we need for this kind of exercise. In a nutshell, we perform an exercise in which we project scenarios, about which I will speak in a minute, over the next 30 years, and on a vast sample of corporates. And we use a static balance sheet approach. So in this sense, it's similar to the current EBA exercise. We basically assume that the firms that we have now, we would have them along this 30 years path. So there is a sort of, if you want, counterfactual mind exercise that we have to make, in which we say, for the purpose of this exercise, the structure of the economy in terms of sectoral composition and size composition of firms remains more or less unchanged over the future. Now, of course, this is a limiting assumption, but like I said, this is a starting point. And from here, as I will say at the end, we will try in the future to build something more realistic and try to understand how climate change could modify the dynamics of the corporate sector. But the basic assumption so far is that the corporate sector remains stable in its essentials. So we used 3 climate scenarios that combine transition and physical risk. We start with the NGFS scenarios, the Network for Greening the Financial System. It's a network of central banks, supervisors, and international institutions that got together to work together on the important topic of climate change and the financial sector. And they provided already a first batch. They're already at the second batch of scenarios, but we used the first batch of scenarios, which came out, I think, in March. These are high-level scenarios. It's GDP points along a growth path for different types of scenarios with physical risk or with transition risk. And you have a data point for a macro region like Europe every 5 years. So our first job was to detail this from every 5 years Europe GDP to every year GDP for every country. So that was the first challenge. And the second challenge was that the NGFS has either physical or transition risk, and we needed to combine this. So we have 3 scenarios. The green one you see on the chart, orderly transition, meaning we do everything right. Policymakers do things right from the beginning. We keep temperature below plus 1.5% as per targets, and things work more or less smoothly. So that's the best case scenario. We won't call it a baseline, but best case. Then there's a disorderly transition in which temperature in the end rises by 2% because policymakers react a bit slowly to this emergency, and basically they come in later. Some things have become irreversible, and policy measures are harsh and create cliff effects. So they disrupt the economy, and that's transition risk. So there's a bit of physical risk because temperature increases up to 2%, and there's a lot of transition risk because policymakers, by acting later, need to step on the brakes more forcefully. And then there is the benchmark case of the hothouse world, in which policymakers do nothing, so there is no transition risk, but the temperature increases by more than 2%, and physical risk becomes very high. So if we move to the next slide, So we start with these scenarios, and then we collect a large sample of firms. We have more than 4 million firms worldwide, and we, because we have address of their headquarters at least, we match them with the physical risk score, which we bought from commercial providers. Then we also match them to transition risk, meaning emissions, at the level of 4-digit NASA code. Then we put their balance sheets together from Orbis and Icon and Bloomberg and all sorts of databases, and then we map that with our own ECB, EU, Euro area-wide credit register, which has more or less 4 million firms, and with another database we have at the ECB, which is the emissions of securities by 6,000 firms in the Euro area. So we end up with a firm sample of about more than 2 million firms, which cover more than 80% of exposures in the credit register, and a bank sample of about 1,600 consolidated banking groups in the Euro area. So after this massive effort to put together very granular information at the firm level and at the bank level, if we go to the next slide, this gives you a perspective of what the risks are in Europe. On the left side, the thing which I call the tartan, because it looks like a Scottish pattern, is a cross between countries and sectors, and you can see what sectors in what countries have a higher level of emissions. So this is a map of transition risk. And on the right-hand side, you have a map of physical risk. Now, I should mention that the dots represent firms. So when you see an area with not much in it, it doesn't mean that there is no physical risk. It just means there's few firms there. And what we see from this map is that there is physical risk in many places in Europe, but the sources of physical risk are different. They tend to be more linked to wildfires in the peripheries, such as Greece, Portugal, Spain, Italy, and more linked to floods in Northern Europe. So the lesson here is that physical risk affects most regions, but it affects them differently. The source is different, and therefore the policy response is likely to be different. If we go to the next slide, so the next challenge, once we have our database and our scenarios, is how do we transform a measure of climate change risk into a measure of financial risk to see in the end what is the risk in a bank's portfolio. So the risk drivers for physical risk, we identify them as damages to physical capital and disruption in the production patterns, which can be mitigated by insurance. Although insurance costs, of course, means an increase in general costs. And for transition risk, the drivers would be the cost of emissions and the need to adopt new technologies and improve energy efficiency. But there's also a channel of demand for goods. So we think that tastes of the population might shift, and we will all spontaneously want to buy less goods that are intensive in terms of their, either in emissions in their production process or in their functioning. And so, of course, that creates a problem for firms that produce these goods or that have these polluting technologies. So basically, we map these drivers into firms' revenues and costs and debt, which then gives us an impact on the key measures for financial risk, which are profits and leverage, which we then turn into a PD. So if you want, it's a multi-stage project in which we model how the risk drivers affect, if you want, the infrastructure of the firm, so revenues and costs and financial structure. And then from there, we see how these things affect the classic financials of firms, profits and leverage. And from there, we move to risk indicators. So we do this for every firm, and then we map that into banks' portfolios, and we get default probabilities for banks' corporate portfolios. And we do it for credit and for market risk. So we also have losses from corporate bond repricing. Now, bear with me. This is all done with this concept as if people didn't know what would be happening along the scenarios. So this, as a financial economist, I would say that bond would reprice today if we knew what the path were for the future. But this is not how the exercise works. We just assume that people discover things as they go, so things happen gradually. It's a simplification because otherwise things would have looked very strange. But we acknowledge it's a simplification. If we go to the next slide, so these are the results. You can see on the left side the PD of median firms, how they evolve in time. You see that this is as a difference compared to the orderly transition. So you see that at the beginning, the orderly transition has a cost. So at the beginning, firms look for the first few years, firms' increase in risk would be lower with the disorderly transition, with the hothouse world, than with the orderly transition, because orderly transition means starting immediately with higher taxes on carbon emissions and things like this. So the firms start paying the price from now on, while in the other two scenarios they don't. So it's better for them. However, at some point, and the break-even point, if you want, is around 2030, the situation reverses, and long-term, the probability of default of firms increases compared to the baseline scenario by a little. At some point, it plateaus with the disorderly transition, because in the end, the disorderly transition, if you want, converges to the orderly one, with the only difference that the world is a bit hotter. While in the hothouse world, let's say, at least over this horizon, things get worse. It converges at some point, but over our horizon, it just goes up. And then when we map that into banks' portfolios, as you can see, we see the same pattern. Now, diversification, of course, helps banks, but the key point here is that there is a short-term benefit in doing nothing, but the long-term cost, which is far greater than the short-term benefit. And if you go to the next slide, what's next in this in our work? Well, we published by the end of September our results. So what you got here is a preview, and then the key development in the foreseeable future is to have a dynamic framework to capture banks' response to climate risk, but also firms' response to climate risk. Now, we're going to use these first results to help our colleagues in supervision. As you know, in 2022, the SSM will have its switch year stress test exercise focused on climate change. And as we speak, they're interacting with the industry and so on to define methodology and templates and so on. But we'll be providing support as much as we can with internal benchmarks and scenarios and so on. The Eurosystem balance sheet might be tested for climate change, for climate issues intensity. So if this happens, we're going to support our colleagues in risk management at the ECB. And then we will extend, we're already in the process of extending our methodology to other financial intermediaries. We already have a bond pricing mechanism. As I explained before, we're working on equity valuation mechanisms. And so we will be able to use that for asset managers and insurance company portfolios and see what things look like over there. But I would say that the most important thing here is to understand how firms will adapt dynamically by, we can't really model the innovation, but we can model the spread of innovation and differentiate more shocks to supply and shocks to demand. Like I said, it could be the case that tastes change more quickly than anticipated, which will be a problem for many firms, and as a reflection of that, a problem then for their suppliers of credit. Thank you, Chair.
Thank you very much for the interesting presentation. I would ask Giorgio to continue.
Okay, thank you very much. In this presentation, I go back to Jakob's presentation, and I will maybe present a few additional points. In particular, I will make a comparison between 2018 and 2020 stress test, 21 stress test, explaining the main differences for a bank perspective. No? We have run as a McKinsey benchmarking of all the banks who participated to the exercise for let's say, to avoid any sort of conflict at this stage, we have just replaced the names with just the country of the company and a number, or 1 to 10 for each of those banks. So you won't see many names in the presentation, but of course we have run a complete and thorough comparison. Based on the results, what Jakob was already saying, the CT starting point this year is already quite robust. We started, all the banks started with an average CET1 ratio of 15% compared to the 13.8 of 2018. What this means is that it is true that if I go directly to the fourth point here, I don't want to go on topics that were already discussed by previous speakers, but if you see the drop was around 485 basis points, but the banks, however, they landed to a level that is very close to the one we saw in the previous exercise. So stress lending position is only 24 basis points worse than the previous stress test exercise in 2018. In terms of country, we saw quite a big dispersion in terms of results because we have 80 basis points as a minimum drop in terms of capital depletion and a maximum of 990 basis points. We have considerable country level differences. Denmark, Ireland, Italy, Germany, and France are the worst in terms of impact on capital depletion, whilst Poland, Norway, and Spain showed better results in terms of country. In terms of stress test results, as was already pointed out, the way that the exercise was run by each single banks in terms of timeliness of responses, data quality during the quality assurance process, governance of the stress test, these will all be taken into account and will be included in the determination of the P2R. I think there are already ongoing discussion for the SREP results of 2021. The P2G instead is going to be computed based on the stress test impact. A new methodology has been released this year, and we will go shortly in looking at that. These are just the 50 banks that participated to the exercise. We know that there are other 53 banks that participated as a part of the ECB exercise. What I want to note here is that whilst the 485 basis point capital depletion has been the results of the EBA exercise, with respect to the ECB, who ran a parallel stress test, there the average depletion was 680. So there is a big difference, and this is mainly due to the fact that banks are less, let's say, ready given the dimension to the pandemic, and they suffered more than bigger institutions. So we have this kind of difference. In terms of lending, we already saw that the lending was around 10.3%, but we have a top quartile who landed at 13.8, and a bottom quartile that instead landed at 8.7. It's important here maybe to make some only 6 banks, sorry, have improved 2018 stress test capital depletion under adverse scenario. So it is indeed a more severe scenario, given the fact that only 6 banks have managed to have better results. And here again, we reinforce the message, because if you compare stress test 2016, both in terms of capital generation under the baseline scenario and in terms of adverse impact, so capital depletion under the adverse scenario, you see that we increase the capital depletion over time, starting from stress test 2016, where this number was around 360 basis points, and we go to 468 basis points in 2021. So again, of course, fully loaded and with a weighted average and simple average. So of course you have different results, but the message is always the same. This exercise is much more severe. Then what we have done, of course, we have this analysis run for each bank, but here we just put the average of the market. What we've done, we try to compare the depletion based on broken down by different performance driver. And indeed, we saw that NII had 80 basis points of drop. And this is due to two things, mainly the starting point rates that are quite low, and the macroeconomic scenarios. So we know that there is this assumption of replacing any maturing, let's say, assets with the interest rate of the current production. And so since the current production has been all originated with low interest rates, these of course had a huge effect on NII, plus the idiosyncratic and the sovereign spread shock that also play their role in this methodology. Also in terms of net fee and commission income, we see a deterioration compared to stress test 2018. And this is due to two elements, maybe, at least based from my experience helping some of those banks, that the quality assurance this time run by EBA and the ECB has been very thorough. So they have launched specific quality assurance template this time, asking for the statistical robustness of each model that the bank was using, also asking for the use test, so understanding whether this model was already employed by the bank in some of their processes, as well as validation from the validating unit of the bank. Of course, this exercise was giving, in certain cases, lack of robustness or lack of, let's call it, quality assurance in some of the models that the banks developed. And so, because of that, they had to revert to the floor or the cap of the methodology, losing the benefit of having their own internal models. Then, in terms of credit risk, you see, sorry, in terms of market risk, there is also a harsh effect with respect to 2018. And this is also true due to equity shocks that have been run and have been assumed this time, that were a little bit harsher than 2018. And in terms of credit risk, there is a 37 basis point aggravation. So it's always credit risk the big driver of the depletion in this case, but even more this time, also due to calendar effect. We know that the calendar effect last time was not biting the stock of NPLs because it was the implemented just for the first time, and only in year 3 you had in 2018 some effect. But in this exercise, especially for the unsecured portion of the portfolio, NPL calendar was for sure impacting the credit losses. With respect to P&L, instead, we can see some improvement that we justified, thinking that maybe the industry became more efficient, more efficient in terms of managing their own P&L. And so we have recorded a 91 basis point improvement. And finally, RWA is also more severe, the impact that we have recorded. And we believe it is mainly due to the severity of the shock, especially on credit risk. So at the end, based on this, we have tried to map the world of the banks according to 4 buckets, taking 2 dimensions. From one side, the resilience to the stress, which is the delta of capital depletion, fully loaded, baseline versus adverse. And on the other side, the capital creation under baseline. So again, delta, CET1 ratio, fully loaded, baseline versus starting point 2020. And based on this, we have bucketed the banks in 4 potential clusters. So the banks that they show a good resilience, the bank with a medium resilience, so they maybe had a capital drop higher than 600 basis points, or they were not able to generate capital creation under the baseline. And then the banks with a low resilience, and the bank with low resilience and no capital generation. As you see, based on this McKinsey clustering, we have 17, 19, 6, and 8 banks divided in those clusters. I will jump this part, and I will tell you that one other topic that we have shown here is a clustering of the performance based on drivers, P&L drivers, moratoria, and then implication P2G. With respect to the different dimensions, so we can say that we have seen a capital depletion of around 300 basis points. We have seen a capital generation of around 300 basis points under the baseline for the most important, what we say the resilient bank. While 9 banks, they have shown capital depletion of up to 140 basis points. So again, the results are quite diverse. In terms of historical comparison, we saw that over 85% of the banks recorded stress test impact that are larger than 2018 exercise. And only 6, as I was saying before, improved their performance. In terms of, we have also seen capital versus RWA impact, where single banks record up to 25% increases, and we have seen one case of full capital depletion, whilst the industry average is around 12% in terms of RWA increases and 24% in terms of capital reduction. I think those numbers shows that anyway the result is of this exercise is more severe than others. One thing that maybe I want to highlight is the moratoria part, because it was also mentioned in the previous by the previous speakers. And the moratoria shows that the cost of risk of moratoria portfolio is around 3.9%. Again, this is a huge result, because if you compare it with the cost of risk of the total portfolio, which is 2.2%, we are saying that there is almost twice as the amount of cost of risk linked to moratoria portfolios. And then stage 3 assets in moratoria portfolios, according to the projections, are expected to rise from 3% in 2020 to 13% in 2023. So indeed, the pandemic has affected some of those banks. You know that EBA has published a discussion paper before the pandemic started on the future changes to EU-wide stress test. No? So I want to, with a supervisory leg and a bank leg. So this is still a consultation paper. The industry replied to this consultation paper, and I want to maybe outline some of the challenges that banks foresee. So, of course, the fact that in that paper we talk about supervisory leg and bank leg, plus the ICAP, which is the third exercise that the bank should undergo in 1 year, let this exercise become very resource intensive. It is true that the regulator could say supervisory leg is run by us, so you don't need to work on the supervisory leg, you just provide the raw data and we will run it. But it is indeed true that the bank will need to challenge any differences between supervisory leg and bank leg. So somehow they should anticipate what the supervisory leg results will be in order to be able to reconcile quickly with their bank leg. So this is indeed true that the resource intensive aspect remains. Then there is the industry says, okay, but if we start going towards this direction, we should try to use as much as possible banks' internal models in order to avoid lack of efficiency, because we are already in a very high operational burden. So we don't want to, again, use specific models, ad hoc models just for the bank leg. Maybe it's better to use the ICAP models for both exercises, bank leg and ICAP. Of course, here there is a skepticism usually from the supervisory community about the use of internal models of the banks. And there is still in the market a lack of stress test internal model standards from the banks. So they are quite different. So it is true that in that case, maybe a quality assurance check from the supervisor could be needed.
Thank you. It was very interesting. So I would pass to Jakob, please.
Thank you very much, Gottfried. The reason that I'm interested in stress tests is especially the market discipline perspective. I show here a quotation from the report suggesting that by providing extensive and detailed bank-by-bank actual and projected data, this whole exercise will foster market discipline. And of course, whenever you talk about market discipline, the key thing is how do financial markets, notably the stock market, but also other financial markets, react to the publication of all this information. And that's where I come in, because that is one of the issues that I've been doing research on during the last couple of years. Most of that research, including one of my papers with my co-authors, published in the Journal of Banking and Finance, provides an overview of that work for the US, because the US started earlier on in this business. Several institutions in the US are and were involved. The stress test differed quite a lot. And this result, this research suggests that, yes, sometimes financial markets indeed respond to the information provided. So suggesting that apparently these test outcomes are news for them, something they didn't know, and that led to adjusting prices. The research on European stress testing, academic research, is also there. I did one paper myself with a co-author. Please, next slide. And that study focused on the ECB's comprehensive assessment. And much to my surprise, I must say, because I thought that comprehensive assessment was very informative, but what we find is that financial markets, both stock prices and CDS spreads, generally did not react to the publication of the results. And more interesting even, at the time, we also found that even banks with a capital shortfall, according to this analysis, did not respond differently than banks that did not have shortfall. So this suggests that, at least in this particular exercise by the ECB, the comprehensive assessment did not have a major news impact on financial markets. Unfortunately, I cannot show you the results for the current stress test that we're discussing today, because we're still working on it. But at least I have the expectation, the prior, that perhaps this time the stress test provides information, news to the financial markets, and that they will respond to it. My prior is that, especially given the large variability that we see across banks in terms of their NPL ratios, their return on assets ratios, etc., that I would be surprised to see that there would be no difference across the banks, and my expectation is that we'll see different results than in the past. And the reason, next slide please, is that if you look at the immediate response, in this case of stock prices, then you can see that there are differences, quite substantial differences, in fact, across banks. This is only a subsample of banks, but at least this suggests that there is a reaction, and also a different reaction. So this suggests that apparently this current stress test provides new information to the market, and that leads to repricing of stock prices. As I said, I hope to be able to present the more detailed results at some point in the future, but my initial reading is that this particular exercise may lead to more of a reaction than similar exercises in the past. Next slide, please. That makes it all the more important that the selection of banks in a stress test exercise as the one that we have heard of today is clear. And all of you have heard by now a number of times that in the EBA SSM exercise, there were 50 banks involved, which is quite a high number. But to me, it's not at all clear why these banks have been selected and others have not. So what I did, just to get a better feel for the selection criteria, I looked at those banks that I'm most familiar with, i.e. Dutch banks, and then, not surprisingly, some of the larger Dutch banks and well-known banks, I guess, are included. But there are also two banks included, PNG and NWB, and both of these banks, in terms of their asset size, are quite substantial, but both of them focus on loans to government, local governments especially. So from that perspective, I have my doubts how useful it is to include them in this exercise, while the Volksbank, which is a smaller bank but similar in terms of activities like to ABN AMRO, ING, etc., is not included. So I'm wondering why. The more so if I look at the balance sheet side of this bank and compare it to Volkswagen Bank, because Volkswagen Bank has been included, and as you can see in terms of their balance sheet size, they're pretty similar. And why am I so worried about the Volksbank not being included? Well, because that's a bank that, at least in the past, was kind of problematic. Let me put it like this. It was only due to the bailout by the Dutch government that it survived. So I would have liked to see that bank included, especially also from this market discipline perspective. This is just an example to illustrate my general point that I'm kind of worried about the selection of banks included in this exercise, especially if you like financial markets to digest this information and to respond to it. I think it's important to be very clear about the selection of these banks and so that it's clear how this 50 banks have been included and why others have not been included. Well, some of them, might be an interesting case. So that's all I had to say. Thank you for your attention.
Let's continue with the next speaker, Fernando, please.
Good morning, everybody. I'll try to also be quite brief. The highest capital depletion in history displayed by European banks will not prevent the return of capital distributions for the industry with increased dividends and capital buybacks coming up in the short term. That as a highlight, so I'll try to focus on the capital distribution more than on the other topics that have been covered. This provides you with the 4 points that I will try to cover. We'll talk a little bit about the history. We'll focus on the new capital distribution approach displayed by the ECB related to P2 guidance determination and how it will be calculated and how it fits to the capital results observed in the stress test. In terms of country coverage, I think those countries that had lowest net income capabilities were the most damaged: Denmark, Ireland, Italy, Germany, and France. And those countries with banks that had diversified operations or higher NII absorption were less impacted. I'll also touch a little bit on the future, primarily climate risk and the new EBA approach being consulted with the industry. So if we move to the next slide, this contemplates or provides you with a history of a stress test in Europe. It's been more than a decade. Some of us that have been around count a stress test year like a cat year. So it doesn't count like one, it counts like 4 because of the amount of work that we have to deliver during a stress test year. So we can write a history book around stress test results. You can see that the depletion in Europe has been growing. That's the red bar. So the stress tests have become more severe and credible, but also the capital flexibility of banks has increased over time because of the capital formation that the industry has been able to do. So that also indicates a stronger ability of the banks to restore dividend and buybacks. In the next slide, something similar to what has been already presented, so I won't stop a lot. Just focus on the fact that credit is the biggest driver. I think the stress test results display stage 3 and stage 2 statistics, which are new and something that the credit risk practitioners will appreciate. Stage 3 going from 2% to 6% in the adverse, and stage 2 levels going from 8 to 14%. And the credit losses, as COVID-19 has showed us, being driven by the corporate book, about 50%, and 35% consumer lending portfolios. So not a lot of impact coming from the mortgage side of the business. If we go to the next page, something that we track in terms of the capital depletion, CET1 available against the original 5.5 threshold that was used in the past. Only one bank did not meet it, Monte dei Paschi, with a capital plan already in place. No other bank has shown needs to raise capital. In fact, there hasn't been any equity raising activities in banks over the past 2 years compared to prior years where there was extensive capital raising. So no surprising results here and strong resilience displayed by the banks. Let's go into the next slide, which is, I think, the most interesting aspect to us, and one that drives the most attention by the market, which is the P2G calculations, what the ECB wants to do to determine P2G, which is displayed in this slide, bucketing the banks based on capital depletion and making a stronger link between stress test results and P2G requirements. We would appreciate, there's a lot of transparency in the stress test results, but this is the gray area, and we would appreciate more transparency here. This was not provided by the ECB when results were disclosed, but we aim at implying the P2G levels based on this approach, which is included in the next page. And that get us into 4 buckets. When we imply the P2G without the supervisory adjustments, we see banks that have high capital depletion, meaning low capital resilience, but also have small buffers after you include P2G in their capital stack of requirements, and therefore will be less prone for capital distribution vis-a-vis the ones on the right-hand side, which will have higher capital flexibility and markets appreciate the potential increase or bigger increase of dividend distribution. So those banks, I suspect, were the winners, the ones on the 2 red, green zones. And this is what the market focused on. The market was already expecting a strong, resilient sector, but was very much paying attention to the ability of restore the ability of the sector to restore capital distribution. A couple of words on the go forward, and I'll stop on climate. As it was discussed, we have a stress test on climate next year. Europe is taking the lead here. In capital stress testing, the US took the lead with CCAR. Here, Europe and the UK it's now running a stress test. The ECB will run a climate stress test next year. So clearly, Europe taking the lead on this new emerging topic. And a couple of areas to focus for next year. One, the stress test results for climate will display portfolio alignment metrics for the banks. That means how quickly their loan portfolios will migrate to neutral emissions. That's a very important strategic consideration for banks. And then secondly, certainly this will drive climate risk capabilities being developed in the industry, which are very immature and in development stage. Lastly, on the new approach for capital stress tests, I have shared my views on this with the EBA and the ECB. we're not advocates of the two-leg approach. In the US, there are two legs, and they create confusion, and markets only pay attention to the binding leg, which is the regulatory leg. We would recommend to have one consolidated approach and result. We would recommend to rely on bank ICAP bottom stress test projections, and allow those banks that do have sound capital management practices use those internal estimates for stress testing, and those that don't, and the ECB knows because of the they supervise capital and ICAP practices, can go into supervisory benchmarks. We would also recommend stronger linkage of the stress test results with capital distribution decisions. So let me stop there. Thank you.
Please, Elena, if you would like to continue.
Yes, thank you. Thank you very much. And thank you for the invite to participate. So let's go to our key takeaways. We think that the results of the stress test show that the banks could be resilient if they were to face another economic shock, and they benefit from stronger capital levels than before. Obviously, there has been a big divergence in the results, so one should look at the individual results carefully as well. Broadly, we don't think that the results led to any surprise that would make us reconsider our ratings on banks. But obviously, as part of the ongoing surveillance, we will discuss with the banks how they perform in the stress, what were the drivers of that performance, and all the amount of data that has been made available. We don't think that the regulatory consequences could be that significant, especially the negative ones. Obviously, those that perform weaker could eventually face higher capital requirements, either higher P2R, higher P2G, or they would be asked to take corrective measures. But we think those could be a minority. And actually, for most others, what the stress shows is that they could have an argument to at least ease some of the regulators' concerns regarding the resumption of dividend distributions to shareholders. On the fourth point, so looking at the base case scenario, we think that the data disclosed aligns with our view that the pandemic is probably not likely to generate a significant capital depletion at banks, but that the main issue is that the profitability and the weak profitability is becoming more of a structural problem. On disclosure, so we do acknowledge that the stress test is a regulatory tool, is a supervisory tool. That's the main objective, but it's also a great exercise in terms of disclosure and transparency to the market. A lot of valuable information made available for market participants, including us, that would help us contrast our views and opinions. And what we see is a bit of different level of disclosure between the EBA and the SSM. So maybe, hopefully, in the future, we could have a bit more details on the entities covered by the SSM. We think it would be useful. And then finally, an important message that came up from the stress test, and we've seen that also in previous exercises, is that really there is a big risk of coupon non-payment on hybrid instruments in a situation of crisis, and that's something investors should keep in mind. So maybe I'll elaborate a bit on all these topics. On the main conclusion, European banks prove resilient. I mean, the highlights have been mentioned, so I will not repeat them. I think we share the view that it's important to know that the institutions were resilient in spite of a tough macroeconomic environment. And that is something that we think was different from previous stress test exercises. In terms of the baseline, the GDP growth forecast aligns very much with our forecast, is a bit more bearish on the unemployment performance. But what was important for us was to see that in the adverse, yes, we do see a much tougher macroeconomic scenario than what we have seen in previous exercises. The economic contraction continuing in 21, 22, in some cases even in 23, on top of the big shock in 2020. So overall, we think that it's a scenario that aligns more to what we consider a single A type of scenario, and is the one that we use to in our capital model. Also, the adverse scenario was more consistent than in previous exercises across countries. If we go to the next one, I mentioned it and others did too, divergence of results around the average, different degrees of capital depletion and different ending points. So for us, what it is important is to understand the drivers and the reasons, and we will be holding discussions with the banks individually to understand, and also understand to what extent the results diverge from their own stress tests, and to what extent the assumptions could have conditioned the outcome. And then on the issue of disclosure that I mentioned as well, maybe on the right side, we have the broad disclosure by the ECB. Maybe where we are missing a bit of disclosure is in the group of banks at the bottom, banks that would see their CET1 falling below 8%, but we don't know by how much or how serious the situation could be. So maybe a bit of more disclosure on those would be useful. Then on the following slide, as I said, we don't think the information will lead to rating actions. Our ratings are based on base case expectations, not stress test assumptions. And in the information that has been disclosed, we haven't seen anything that would challenge our base case expectations. As I said, this scenario is fairly aligned. And in terms of broad expectations, also there is alignment as well. We do expect, yes, credit losses, problem loans to emerge at some point. We haven't seen much asset quality deterioration yet, and we know it will come. But there has been a good provisioning effort already in 2020, and there will be more. And the level of provisions we think could be absorbed by the banks. In terms of capital, we think that the capital has reached a peak in 2020 and will decline a bit in the years ahead, but something quite manageable, which seems to align with the numbers we have seen in the base case. But then it's more an issue of what this scenario of very low rates means for profitability, and I will comment a bit on that in the next slide. So today we only have 10% of ratings on negative outlook. We used to have 43% or so mid last year. We've taken a lot of revisions through 2021. And in most, we've lowered some bank ratings, but only a minor share, and mostly to reflect business model challenges. But we have revised quite a few numbers of quite a few outlooks from negative to stable. So on the profitability, so we are already highlighting that we don't see that much of a risk of several downgrades across the board. So the main challenge is, in our view, for banks to restore profitability to levels that are more consistent with their cost of capital. And certainly the environment is not going to help. The very low rates, very limited business volume growth. And that seems to be as well the conclusion of the stress test. It's true that there are a lot of assumptions that will not materialize in practice, in reality. So the static balance sheet or the ability to manage costs down. But I think the charts are self-explanatory that even under the base case, and even if pre-tax profits could improve a bit by 2023, the margin erosion expected in the baseline is quite significant. And we understand that one of the constraints, which is that banks will not be able to manage their operating expenses, will not hold through. Actually, banks will have to focus on the cost side if they want to improve their profits. That's the big challenge ahead. In the adverse, well, the system would get into losses. That is to be expected. I think what is an important takeaway is that not only the contraction of net interest income is very substantial, is that there is expectations of declines, significant declines across all other types of revenues. And we think that's a plausible outcome in stress scenario, and that would put banks into trouble if they don't really manage to cover not only the expected credit impairments, but their operating cost. So moving to the next slide, yes, in terms of regulatory consequences, as I said, we don't see major negative consequences. Both the EBA, the ECB express comfort with the results of the exercise, and we'd rather see the opposite, that maybe banks use the results as an argument to support their capital distributions to shareholders to pre-pandemic levels, which is what several of them envisioned. Yes, there could be banks that could be asked to take remedial actions, but in practice, we probably only see Monte dei Paschi as having capital raising, but the bank already committed to it, so not big news. And yes, for the rest, the outcome will help regulators to set up their SREP. Some could see their P2R increase, the P2G increase, but in principle, we don't think that banks will have problems in facing or complying with potentially higher capital requirements.
Thank you very much. So I would suggest that the next round, I would give the floor to Jakob and to Carmelo.
Let me try and make Giorgio and Fernando a little bit happier. I think your comments on the two legs are well taken. I think that feedback has in fact been taken into account. So that's not what's going to happen, right? I know there was a discussion paper that was produced some time ago. When I hinted that there would be a hybrid approach, I think that's exactly the response and the reaction to that input on having preferably not having two legs. So I think here we're trying to do something which is a little bit of a mix, but as I said, predominantly bottom up. If I can just make one observation here, stress testing was a debate that began back in the early 2000s at the BIS at the first round. One of my first roles at the BIS back then, and even back then there was this debate about top down versus bottom up versus should it fit the individual bank, should it create comparability and whatnot, right? So here we're trying to get a little bit of the benefits of both approaches in what's going to happen going forward. So that would be my first response to Giorgio and Fernando on that particular point, right? The second thing I would say, and this is maybe to our markets impact interested Jakob, the other Jakob, I understand the request, but I think the exercise here is of a different nature. So while I have sympathy for the sample size question or the sample composition desire, I think what we're doing here is based more on size and economic importance and banking system importance. If you read the methodology, that's basically the selection criteria at heart, if I can say that, right? I think what was there another, and then I would finally say I'm as a general comment, I'm really happy to see the analysis both by rating agencies and by analysts and by consultancies on using the data, because I can tell you that a lot of work goes into this, both in the banks and in the regulatory community, in getting this done, right? I think that the quality assurance work is substantial. The effort by the banks is substantial to do the effort. So I think it's really nice to see that you are scrutinizing it and you are asking questions. Finally, I would say I note with some satisfaction again that you agree with me on where the challenges are in the climate risk space when it comes to stress testing, right? I think, as you do, I think we have some good scenarios. I'd flag the IPCC report as well. So I think we have a lot of good guidance on where the risks are coming from. I think it's the translation into the bank's balance sheets that will remain the challenge for some time to come, as a general observation. And I think that is where rubber hits the road for the kind of exercises we're talking about, right? So I think for me that's that is going to be the main challenge going forward, I think. Yeah.
Carmelo, would you like to add something?
On the choice between bottom up and top down, I think that it's a matter of also of cost efficiency. I mean, on the one hand, banks complain that the stress test is a lot of work for them. On the other hand, if we look at the US experience, which is top down, there is still a lot of work from banks in terms of providing data, and then they're unhappy that their data are assessed by other people's models. So I don't think that there is a right answer to this question, but we have to put ourselves on a continuum, on an indifference curve, if you want, of what are the goals of the exercise versus what kind of resources we want to invest in it. In the US, the stress test goes directly into distributions, so the investment is massive. In Europe, the stress test goes into supervisory actions, but it's a bit mediated, if you want. It doesn't go directly as is. And so this can be done also with a different level of investment. So, I mean, personally, in my experience, there are some things that could be done more efficiently with a straight top-down approach, because we don't see much benefit with banks working on that, and we could do it for everyone. But there are other things in which I think the input of the bank is key, and then the dialogue to understand where the numbers come from adds a lot more value than doing some sort of haircuts from the center, which are not really explaining much. So in my view, the process of reshaping the exercise just started. There was going to be, let's say, a 2.0 stresses in 23, but I don't think that that's the end of the story. It's just the beginning of a new story. And as for the impact on markets, our own internal studies, we do every time a quick check of what's the impact on markets of the release of the results. And on average, we don't see much, but we take that in a way as positive, because once you know the bank's balance sheet, and you know the scenario, and you know the methodology, and these things months before, if we were to give radically different results from what people expect, I would say there's a problem somewhere. So the fact that the reactions are small is comforting, in the sense that there is no hidden bug in the system, if you want. Thank you.
There was a comment about the link between the stress test outcome and the Pillar 2 guidance given to banks in terms of capital requirements, right? I think that is being strengthened as we speak, and I think that will, if that becomes more clear to people over time, I would expect that then there might be more of a market impact going forward. But I very much agree with Carmelo, right? If it's not a surprise, you shouldn't expect to see a market impact, really, right? So I think this is a little bit of a, so no price reaction, in other words, does not mean no market discipline. I think what's interesting is to see how the banks behave afterwards, right? And there you do see a change in behavior for those who are close to their regulatory, let's say, thresholds, right? So you do see a change in behavior. So there is some notion here also down the line in the pricing of bonds, and I think the hybrids point made by S&P here is well taken, right? I think that also comes into play.
We got two questions from the participants. The two questions concern, first of all, the NPL issue. So the question is, are there any comments or findings on how banks address NPL issues and how that might be related to stress test results? And the other question is around the issue of banks' governance issues, quality of management, state aid, recapitalization, M&A trends, etc., and how that might transpose and lead to interpretations in the stress tests.
I mean, I can take maybe the last one about the governance, state aid, etc. I think there is those elements are really not for the stress test. I think there is here I'm looking at you, Gottfried, there is an SUERF exercise that takes place, right? So based on my experience, at least those aspects are covered in the SREPs, right? So they are part of the foundational work done by the supervisors to provide the Pillar 2 capital demands to banks, right? I think that would be one. So I'm not sure this is a core. Again, also I think just as a general reminder to people, at least for the EBA stress test, we have a static balance sheet assumption, right? So we don't allow banks to somehow respond behaviorally in our analysis, whereas Carmelo has more of that, right? So I think just as an observation, I think the EBA stress test certainly is not the place where you deal with these issues, if I can answer that one. Yeah.
There is a question for Jakob Haan from Franco Stragiotti, and he asks, is there evidence that no reactions on bank stock prices, good or bad stress tested banks, is observed, indicating that stress tests are becoming boring or old story, and markets do not expect much information from the exercises? What lessons is there for supervisors on this lack of feedback from financial markets? So Jakob, perhaps you could answer that question.
Thank you for that question. That's clearly not an easy question, to be honest. But look, I think there's the obvious defense, right? The obvious defense, and I think which is a fair one, by the way, is to say, look, what regulation has in fact succeeded in getting banks substantially better capitalized over the last decade, right? It has also, I think, succeeded in capturing in a better and more comprehensive way the risk profile of the asset sides in the banks. So from my perspective, this is in a sense good news from a financial robustness and stability perspective. I recognize that when you then are looking for financial market reactions, then you may get less than what you have seen in the past, but that's in a sense a measure of success from the end objective of all the regulation, including the stress testing, which is part of a wider toolbox, right? So I think that would be my first comment. The second comment would be, as back to Carmelo's, this is still evolving. And I think that as we go forward, there will be a shift, perhaps a little bit away from capital adequacy concerns towards climate risk sensitivity concerns and focus for the banks. That seems to me to be the new, a bit of the new frontier also for us regulators that we need to address and respond to that societal issue, right? So it's in a sense there's a new problem field that's being dumped in our laps as banking supervisors and regulators that we need to respond to, right?
Perhaps as Jakob Haan was also addressed with that, would you like to add something on that question?
I think I basically share the other Jakob's views in the sense that if you don't find a market reaction, that does not for sure imply that this whole exercise is not useful. It only implies that apparently the information provided is not news, in the sense that markets respond to information they did not so far had included in prices. By the way, this is not a uniform result. You know, the fact that I found it in the ECB comprehensive assessment exercise, we clearly did not find strong market reactions. For the US cases, in several of these stress tests, we do find reactions. So apparently then these stress test outcomes provided new information to markets and they responded to it. So what we are trying to do right now is to see to what extent market reactions differ depending on banks' characteristics. I was very happy with the question on NPLs and the low profitability, as mentioned earlier by other discussants. I think the hypothesis that we want to test is to see to what extent market reactions to the information about the stress test outcome differ across these banks depending on their characteristics. As I said, we're still working on it. I can't tell you the results yet, but that's what we're interested in. So we try to go beyond average responses and see to what extent a particular stock market prices and particular CDS spreads react differently.
Jakob, if I could add one point on that, the US versus Europe comparison. Why in the US prices react? Well, stress test results inform directly dividend and capital buyback decisions. So obviously that's a very important topic for investors, and that's why there's a clear reaction. And in capital adequacy is not the issue anymore. We have a resilient sector. I think there was a missed opportunity this time to use the results for dividend and buyback decisions. We stopped dividend and buyback distributions for all banks across Europe. In the US, that didn't happen. Only those banks that had less capital buffers stopped distributions. I think there's an opportunity to use the outcomes of the stress tests to provide further discrimination on the topic of interest. It's not capital adequacy, it's capital distributions.
We have two rather technical questions. The first technical question was, how do you map a specific physical risk to a specific company? As your sample has more than 1 million corporates, do you use some approximations to classify them into wildfire or flood groups?
The short answer is very simple. The database we use comes from a company that was originally called 427 and now belongs to Moody's, and they have 6 different categories of physical risk, including wildfire and floods, but they're not the only ones, and they map it at the level of address, and they give you an intensity. So basically, I map the address of my single firm into their database, and I get all these 6 measures. So if you're like on the coast of Netherlands, you will have 0 for wildfire and a high measure for floods, and something like this. So we get for every single source of risk a measure, a cardinal measure of risk.
There was another technical issue which is addressed to you. It's on the climate change stress test, and it's on the NACE to define greenness or brownness of the companies. And the question says, could you please specify to which degree of digits you prepared the risk parameter path, and also give some hints if you used public guidance to transfer the taxonomy into NACE codes, and if you did that, can you specify that?
A simple answer. So we bought this data set to a company called Urgentem. What they do is they take the actual measures of emissions as communicated by firms, mostly listed firms. They have about 40,000 firms that communicate their emissions. And then they devise an algorithm that takes into account the size of the firm and the sector of activity down to 4 digits NACE, and they map for firms that do not communicate their scope 1, scope 2, and scope 3 emissions. They use the 40,000 firms they actually have with actual numbers, and they map that into the other firms. Like I said, taking into account a certain number of parameters, among which 4-digit NACE, but it's not the only one.
There's one interesting question that came from Ernest Gnan, and I thank you again for organizing everything and having made possible these great discussions. And if I may cite your input, Ernest, is there something specifically that we have learned from COVID that can be used for the future design of stress tests? And I would like to use that to sum up and to try, at least to try to sum up. I think the discussion has shown that stress testing methodology is on a very high level, that the developments during the last decade has brought us to a point where we have highly elaborated instruments with a highly elaborated methodology, but still, as the world changes, not only to COVID, but also to the ESG issues and other important future issues, there is still need for further developing methodology, interpretation, framing, and application of the stress tests. So I would like to thank all of you very much for attending, for being active parts of the discussion. Thank you again, Ernest, for organizing that, and thank you for the team for making that possible.
I would like to say thank you to all the speakers for sharing your insights with all of us, and particularly Gottfried for moderating this event, and to all of you for joining us. Hope to see you soon again. Bye-bye and take care.
Thank you.
Thank you.
Bye.
Thanks to all. Goodbye.
Bye.
Thank you. Bye-bye.